Fairfax Financial has exploded in value since 2020, and this has made many shareholders very happy indeed. However, we gotta ask, can they keep it up? Hold on to your seatbelts, folks. This is going to be a good one. Fairfax Financial Holdings Limited was founded all the way back in 1985, and they are a Toronto-based company specializing in insurance, reinsurance, as well as investment management. They do manage a diversified portfolio that encompasses equities, fixed income securities, as well as some alternative investments. Many have called them the Canadian version of Berkshire Hathaway, and we'll touch more on that in a moment. However, before we get too deep, I do want to send out a huge shout out and thanks to Missy for requesting this deep dive. We are currently in the beginning of a rate cutting environment. This alone will play a factor, as we do have to ask, how will rate cuts affect Fairfax Financial? In a rate-cutting world, their investment strategy becomes particularly advantageous. Lower rates can lead to higher bond prices. On the bonds they already hold, this will inflate the value of their contribution to their fixed income holdings. Additionally, their equity investments may very well outperform as investors seek returns beyond traditional fixed income assets. As you may know, new bonds have lower yields and are thus they're much less attractive. It is hard to look at Fairfax Financial without looking at their founder and CEO, Prem Watsa. This is a Canadian billionaire that is often compared to Warren Buffett. There's that connection I was talking about. When you look at how well this company has performed since the pandemic, it goes without saying that there may be some truth to that comparison. Through a pandemic, a bear market, and an aggressive rate hike season, you cannot tell that anything out of the ordinary occurred from looking at this company's chart. They have been thus far on a 3-year mission to the moon. Speaking of the moon, a sub to the channel is the best way to orbit future content. For today's deep dive, we are pulling the data from their Q3 interim report, which covers all their fundamentals up until September 30th of 2024. As usual, in reading this report, I did come up with a few pretty good highlights I want to share with you. Their insurance revenue definitely shined as it reached $23.32 billion for the first 9 months of 2024. This is up from $20.03 billion for the first 9 of 2023. That's not too shabby at all. They also reported net gains on investments of $1.47 billion compared to $485.1 million in 2023 in that same 9 months. So they more than tripled their investment earnings. Holy banana bread, I'm liking that. All of this information is pretty darn good, but this is of course a deep dive, so we do need to turn to the numbers. That means it is time to call on the master of means, the Sultan of Subtraction, the one and only Mr. Math. We will start off with a little bit of their surface data. At the time of recording, their current price comes in at $1,876.24. Yeah, this is a pricey one for sure. Their market cap coming in at $42.76 billion, and they have a beta of 0.82. So they are a little bit less volatile than the market average, which would come in at 1.00. Their earnings per share, 227.06. Oh boy, don't see an EPS this high very often, that's for sure. Their price to earnings ratio coming in at 8.26. The average amongst their peers, 16.5. Some of those peers include Definity Financial with a PE ratio of 7.3, Sun Life Financial at 13.4, and Intact Financial at 23.2. Looking at the price to book ratio, that's coming in at 1.30. The average amongst those same peers, 2.4. Switching to their return on equity, that comes in at 16.98%. Return on assets, 4.18%. These numbers look absolutely fine, and they're pretty much exactly what I was expecting to see. Okay, let's peel back another layer and look at their cash situation. When it comes to revenue, that's coming in at $34.17 billion, and they've got $4 billion in earnings. Now, those earnings are projected to actually decrease by 13.5% a year over the next 5 years. That does look initially like an uh-oh, but they've had so much explosive growth that it is really not that bad. It could indicate that they are going to slow down. However, keep in mind that slowing a little from crazy fast is still still very fast. Their profit margin looking good, coming in at 11.86%. On to their free cash flow, $3.82 billion, and their operating cash flow is coming in at $4.25 billion. All right, let's take a look at their fair value. Their current value comes in at $1,876.24. Using a discounted cash flow model, we do get a fair value of $5,690.07. So that does paint them as being undervalued by a whopping 67.3%. When we look at their one-year target, analysts are predicting a share price of $2,020. So that is a 7.2% increase over the next year. I kind of feel like that might be a little conservative. It is clear to see that this is a company with a huge moat. And these numbers give me a growing level of confidence in Fairfax Financial for sure. We already know that we're about to see some pretty good returns, so let's jump into those dividends and return data. When it comes to their dividends, nothing to write home about. It is a 1.074% yield. That dividend is paid out annually in the amount of $20.24. The payout ratio on that, 9.19%. I do have to point out, they do not have a long history of paying dividends. They started in 2020 with a $13.04 dividend, followed that the next year with a $12.73 dividend. Then the dividends stopped, so they cut the dividend, and they did finally bring it back in 2024. Hopefully it is back for good, and the fact they announced a dividend for 2025 is hopeful. Let's switch over to their returns. On their 3-year return on investment, that comes in at a very nice looking 235.04%. Factor in the dividends, we get a total return of 238.69%. On their 1 year, that return on investment comes in at 56.73%. Add in the dividend, we get a total return of 58.43%. These are great numbers, and I cannot complain even a wee bit about them, that's for sure. Okay, let's peel back that final layer and take a look at their debt situation. They have a total debt of $10.71 billion, and their total equity, looking nice, $28.81 billion. So that's a debt to equity ratio of 37.2%. Now, I will point out this debt to equity ratio was at 44.1% 5 years ago. So they are moving the needle in the right direction for sure. When it comes to cash and cash equivalents, they've got a chunk of change sitting around, $8.69 billion. Once again, remember I mentioned a large moat? We're seeing that with pretty much all of this data. Well, let's take a look at the short term. They have assets of $22.13 billion and liabilities of $5.28 billion. I love that. That's fantastic. On the long term, their assets come in at $74.49 billion, liabilities $62.53 billion. So these both look pretty healthy. This debt situation is not too shabby at all. They have the cash flow to cover the debt and the servicing of that debt, and they're moving their numbers in the right direction. So yes, these are numbers I can get behind. I did take a look to see if we had any kind of share dilution, and I would have been shocked if we had. So no share dilution. We do, though, have to take into consideration that there has been significant insider selling in the last year. In fact, insider selling amounted to $470.22 million. There was also some insider buying, but that only amounted to $0.76 million. Mind you, most of that selling took place just over 6 months ago. Honestly, I don't think I'm concerned about it. Okay, I do believe we have enough data for the final verdict. This is a company that I absolutely love. It is a very strong blue chip Canadian company with a track record of success and, well, a very bright future. I do think they are going to continue to grow and produce respectable total returns into 2025 and beyond. I also think the slope of their success, it may become a little less steep, but it's still going to be respectable for sure. The one complaint I may have about Fairfax Financial is that they are priced pretty high, and that could dissuade some investors. Of course, if your broker offers fractional shares, that shouldn't be a problem. Wealthsimple and TD Bank both offer fractional shares, though Wealthsimple is commission-free, which is a huge plus for sure. There is a link below if you want to try out Wealthsimple. They give you 25 bucks for free when you use that link, and full disclosure, the channel also gets $25. Fairfax Financial is great for long-term investors with an eye on those total returns. I think it can still be a great part of anybody's portfolio. If you are interested in Fairfax Financial, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey by checking out this video on blue chip ETFs. Thank you for watching, and I will see you in the next video.